All right, Bill Baruch's been a pretty active trader, part of our investment committee, of course. He joins us right now again because he's bought JPMorgan. So you initiated a small position in JPM yesterday, I'm told, correct?
That's right. And, at the end of the day, JPMorgan is the undisputed heavyweight champion in banking. We've owned Bank of America, but I've been hesitant to build into that position. It's been sitting in the cellar, bottom 5 of our 30 stocks. But I like what we've seen in rates. I like some of the environment coming ahead. I mean, year 2 of a bull market, which we're heading into, is I think financials and healthcare can outperform. So I want to get more banking in there. JPMorgan, I mean, they've guided strong on net interest income, and I just think that they're going to be the leader. So Bank of America may have some catch-up to play here, but in case it doesn't, I think JPMorgan needs to be in the portfolio. So adding the two together, they're in the middle of the pack, even though they both sit in the bottom.
Yeah, I'm looking at financials. I mean, they just can't get much traction. This, issue of where rates are and where projections are and where the economy might be going seems to just continue to hamper this group. A good week here, a good week there. The more medium-term picture looks dicey, though, no?
Absolutely. And my fear here is you look at Bank of America and you overlay that with the 10-year Treasury. I mean, they're trading leg and leg. So you think if you're buying financials here, you have to think that we could be topping in yields. And I do. In the commodity fund that I run, I am long 2-year futures. That's a Stanley Druckenmiller trade. I've been in that just before he was talking about it, too. So I'm positive here that I think we're turning in the rate environment, a big 10-year auction coming up to today. But it's not about right here, right now. I think as we head into next year, a lot of this is going to subside. Again, $131 billion in unrealized losses in Bank of America is an eyesore. So that's why I'm hesitant to add to that. But I want a little more financial exposure in adding JPMorgan.
All right, good stuff. And we appreciate you coming on and telling us about that. We'll see you back on the desk soon. Bill Baruch, Stephanie Link, Bank of America, Morgan Stanley, Amex, which is your largest financials position. Yeah. But the banks.
Yeah, by the way, I feel really good about American Express. They've executed really well in the double-digit loan growth and that sort of thing. So JPMorgan, I don't own it. I can understand why it's attractive. It's down 8% from the highs, and it trades at 1.4 times book. It almost gives you like a 3% dividend yield. And I know they're the best in breed. I do think Bank of America is going to play catch up, especially if you do think, like Bill does, that rates have peaked.
Wait,
I think that will be better.
You just said JPMorgan's the best in breed?
It is the best in breed.
Why don't you own it?
It's too expensive. When I can get Bank of America at 0.8 times, when I can get Morgan Stanley at 13 times. By the way, Morgan Stanley is now yielding 4.5%. That's pretty competitive to the bond market at this point in time, but it hasn't done well.
But I mean, the PE though. Let's show the PEs again on JPM.
I use book value, to be honest. That's how I value banks, and it's trading at 1.4 times. It usually, for years and years and years, Scott, it traded at 2 times. So it has come down, but I'm looking at Bank of America at 0.8 times, and with a good dividend yield, with a diversified business mix, probably more sensitive to the rate market than JPMorgan in terms of net interest income, net interest margin. I think also this whole cash sorting and this deposit competition is probably going to wane a bit with rates coming down. And so I think Bank of America will play catch up. And I like Morgan Stanley because, again, I like the diversified mix, and that yield is really pretty attractive.